Hey, good morning, everyone. Marty Mazzori here, 15th of February, 2022, Wednesday, with your midweek stock market snapshot. I just want to talk at you for a minute, and then we're just going to look at the 1-day and 60-minute chart for the S&P 500. So, thinking a lot about what's been going on in the market here of late. We had the strong jobs data for January that just kind of blew everybody's mind. We had a Fed meeting where the Fed chairman mouthed the word disinflation several times. Market loved the sound of that. He, a week later, or a little less than a week later, was interviewed at the Economic Club of Washington. And the minute he sat down in his chair, the market went from red to green in a big way. That was a day where I think we broke all the records, or it was close to it anyway. One of those days recently, we broke all the records in terms of options volume. And it's this 0-day to expiration phenomenon that we're talking about. Yesterday, it was the vast majority of the big options trades were there. So there seems to be this intraday action that's going on that's quite unique. But in a bigger sense, a little deeper under the surface, or maybe from a broader sense, coming into 2023, hedge funds, for example, on a net basis were notably short U.S. stocks. And it made sense. I've been presenting a pretty negative backdrop. Equity market conditions, our macro index basically points to a pretty precarious setup. So it would make a lot of sense, I think, for, quote, smart money to come in expecting pain early in 2023. Well, didn't get that. In fact, we got the opposite of that, had a really good January. So when you're short something in size and it goes against you, well, then you're going to have to cover, because shorting is essentially borrowing securities that you have to give back, and you expect to give them back at a lower price. You buy them back lower, you give the securities back, and you pocket the difference. Prices can go higher into infinity, so it can become a very dangerous thing to be short the wrong thing, and it goes up. And that's where a lot of big-time money found itself coming into this year. Our weekly appraisal of the futures commitment of traders reports said that by and large, people would just go right back into those short positions, or traders would. There was a point here 3 weeks ago where the NASDAQ was massively net short relative to where it's been the last year or three. And money comes in, pushes the market up, shorts have to cover. So I think the folks who are really smart in gaming this 0-day to expiration, while they're doing it on the call side, I think they're identifying where that short interest is. They're seeing it in things like Tesla, and they're playing that game there as well with real short-dated options. So our research partner, Variant Perceptions, their analysis is that the vast majority of that hedge fund short covering is over with. Yesterday, Bank of America's February mutual fund survey came out. And that's an interesting thing to take a look at. And this chart right here is really where you want to focus your attention. Look where, by and large, mutual fund managers were positioned. And let me jump right to the bottom line here. Equities, substantially underweight equities, substantially overweight bonds, right? That plays into our macro or our economic thesis that, in recession odds favor expansion odds going forward. So apparently, the market or mutual fund managers agree and continue to agree and continue to be pretty stubborn, and they don't want to buy into the market right here, or they didn't so far to begin the year. Now, here's the problem with that. They have benchmarks that they're beholden to. We refuse to do that. I mean, we show you benchmark returns when we report to you clients, but we don't sit here thinking about that every day. We think about investing consistent with our assessment of what the risk-reward setup is out there. Just because stocks have been going up doesn't mean it's a good risk-reward to join the party. But the problem is, if you're a professional manager and people are depending on you to do well to some benchmark that you've established, and it goes against you for an extended period of time, you may just have to capitulate. And then you get good retail sales numbers today, and we'll talk about that over this weekend, and what that portends going forward. And you start doubting yourself. The market's telling you you're wrong, and now the macro data is getting a little bit better. So just about any other year, you would say, hey, the economy's good. Looks like we're entering a new bull market. Things look okay. Or you can make a good case for that. Here's the problem. It's inflation, and it's what the Fed is doing. So to the extent that the economy does come back is the extent to which inflation really doesn't come down to the target that they're looking for. The Fed needs the economy to continue to weaken. So folks who are rushing back into the market thinking the economy is in good shape stand the risk of getting their hearts broken, because the more that goes on, the more it's going to embolden central bankers to stay tight and to push out their anticipated rate hikes in terms of duration, and maybe even increase them in terms of degree. Instead of going 25 basis points, maybe they'll need to go 50 because inflation is just so darn stubborn. So that is the conundrum, is that the Fed can ease off, but we still think it's going to take something pretty ugly in the economy for that to happen, and in the markets as well. And so folks are anticipating better things. Well, if they're right, then this whole narrative that the market should be going up because the Fed's going to be cutting interest rates aggressively the second half of this year, well, that's just the wrong narrative. So you get the catch-22, if you will, that a good economy means continued tight monetary policy, which means probably lower stock prices, ultimately. Or the economy rolls over, we have our recession, the Fed gives you what you want in terms of rate cuts and monetary stimulus, but corporate earnings go to the floor, and suddenly the S&P is at 3,200, which is where we think it should be in a recessionary scenario. So while this market can continue to meander around and maybe break out to the upside, anything durable, anything sustainable under these conditions would require that Goldilocks soft landing scenario, which isn't impossible, but it's nowhere near a 50-50. It might be a 25% possibility. And if the market is trading up based on something that's 25% possible, well, it could absolutely be right, but it's not a place that you want to play in a big way, so to speak. So folks, there you have why we're kind of sticking to our guns, staying hedged. We're rolling our S&P 500 hedge out a couple more weeks. We're hedging some things in the material space that we're crazy bullish on a long-term basis, but we're not in a recessionary scenario, and so we're going to continue to manage those. So clients, you'll get confirmations, and they're not big dollar amounts, but they're enough to provide some meaningful downside protection if something breaks. Okay, so let's just look at the charts real quick here, and I'll let you go. So you're looking at the daily S&P 500. Just kind of in no man's land right here. So here's that double top that we identified back here. Market caught itself right in here. Things got bullish, as I pointed out, with these lines. Let me make that a little bolder. And sure enough, we broke out of that, got overbought here virtually on the RSI. Overbought conditions can correct sideways, by the way. Doesn't mean the market has to go down, and that's kind of what's been happening. Is kind of consolidating in here right at 41.60, and you can see going back a year, let me fix that line, going back a year, you can see that is quite the zone, right? It was support early on, broke that, became resistance the whole way, and it's proving as pretty good resistance right here, and then this double top. So we're kind of dancing between these real tight range. We did get our golden cross here when the 50-day moving average crossed the 200, but the 50 looks like it's flattening back out. Remember, we called this a reverse head and shoulders. That's a bullish pattern. Did break out above the neckline, right, where the shoulders meet the neck. And I said, generally you're going to come back and test that if indeed it's bullish. Ultimately, we think more likely that it fails that before it's all said and done. In terms of our divergences, we did have a higher high here. Didn't quite get there on the MACD. MACD wants to roll over, fighting with it right here. It's when the white line drops below the red line. And you look here, so over the last year or so, almost overbought. Got your sell signal. Wham. Got nailed pretty good. got bullish in here, had our nice rally, got overbought, got your sell signal, kaboom, right? Got not quite overbought, but you got your sell signal here. You're kind of looking like you were back here. You're trying to get a sell signal here. May roll over, may not, may come back. But yeah, technically speaking, you can go either direction with this. This breakout can continue, and that becomes more and more bullish the further away you get from this 200-day moving average, for example. But it looks pretty heavy right here. Looks like a dangerous spot to me. Looking at the 60-minute chart, so recall we had this kind of broadening out pattern here, megaphone maybe, if you want to call it that. And I got cute and I pointed a line halfway between, and I said swing traders can kind of play that. Didn't quite make it, and then broke down below it here. So now you can kind of get away with that, right? If I want to continue to say that's something people will trade, well, then you can kind of see it. Maybe it makes a little sense right there. But at the end of the day, what it really looks like is a consolidation pattern, right? You can come right in here, right off that 4106, right? And then come right in there, and here we are just kind of dancing around within this range, right? Broke out of it, we gapped a little bit lower today, trying to fight our way back up. So not a lot unlike perhaps this consolidation pattern back here, right? I guess I could go here, right? So here we consolidated for a good, 3 weeks or so, and then broke out to the upside. Now, pretty key difference here on the momentum indicator, right? Back here when we're looking at this, I was showing you a pretty bullish short-term setup here on the hourly chart, right? We were consolidating, but momentum was telling us that it looks like we're going to break out to the upside, and that's exactly what happened, right? And then we started developing these, rising wedge patterns, which were short-term bearish, started to roll over here. Now, when we got overbought here, we did not have anything of a bearish nature, right? Well, as you can see, if we were to shoot up to the top of this range right here, there's no way this MACD is going to do anything but give us a lower high, and that's going to be a bearish divergence. Right now, we're not really diverting from anything here. We're just confirming this downward slope here, kind of a descending triangle, if you will. So not the good-looking setup, right, that we had here on the MACD while we were consolidating. In fact, it's the opposite. We're trying to consolidate, but we're not getting much love here in the momentum indicators. So again, I don't know how this is going to play out. It looks to me like odds favor that it plays out lower, which would be consistent with our broader thesis. But this is a tough market. My heart goes out to short-term traders, because a lot was pointing to something meaningful to the downside, a big shakeout and a big purging of that fourth quarter rally, if you will, or those gains. And it just isn't happening. And it may have to do with a lot to do with the flow, the short interest that keeps being stubborn, and they cover, then they go right back to it. Mutual funds being way underweight stocks, needing to maybe start thinking about catching up. So maybe they're starting to buy the dips right here. And then lastly, just came to mind, maybe we should take a peek at on-balance volume on the daily chart. So remember, on-balance volume captures the daily volume up and down based on how the market closes. So the way we look at this is where you're descending, that means that there's bigger volume, more conviction on the down days, right? When it's rising, there's more conviction on the up days. Rising suggests that money is coming in and buying the dip, so we call that accumulation. Falling says that money is coming in and selling aggressively the rallies. We call that distribution. So this looked to me as the market was coming back. See, here you have this, that, for lack of a better term, call it the smart money, was using these opportunities to continue to divest of stocks, expecting the next leg down in the bear market, right? And even here, from this point here to here versus from this point here to here, it just looks really heavy. I just don't know how much upside is left in this thing. And then you could argue, though, but on the downside, you've got a tremendous amount of support to break back through, and you do. And I think you're going to before it's all said and done. I think it's a first half of 2023 affair. But we are very willing to change our minds on our thesis. In fact, that's what we try to do every day, is find disconfirming evidence. What's the scenario where we could be wrong? Right now, the scenario where we could be wrong, I just kind of gave it to you earlier. That's that soft landing Goldilocks scenario. We're more open to it now than we were, say, in December, but it's not yet to the point where it's convincing to us. I'll leave it there. Thank you, folks, as always, for watching and listening. And I'll be back with the economic update probably over the weekend. Take care. Bye-bye.